Welcome back, everyone. Today we're going to be continuing the beginner's course for Forex trading. And in this video, we're going to be discussing knowing when to buy or sell a currency pair in the How Do You Trade Forex section. So before we do get into that, guys, for those of you who are new here, this channel focuses on comprehensive financial education for traders and investors. And for those of you guys who are looking to get started trading, go ahead and browse the description below for various resources provided to assist you guys in that process, one of which being our free community and free daily Forex trading signals that we do provide Sunday through Thursday. Again, those are free and it's free to join. So I would definitely recommend taking advantage of that. It's a growing community of a bunch of like-minded individuals looking to succeed in this market. And you're also going to get signals, resources, and a bunch of more content as time progresses. And for those of you guys who are some of the beginners or first ones to join, or at least on the ground level, there will definitely be a few extra bonuses for you guys down the line. So with that all out of the way, let's go ahead and get started with today's lesson. So starting off, we have know when to buy or sell a currency pair. That's what we're going to be discussing today. And first off, I want to discuss some of the examples that we would go over just so you guys understand the actual fundamentals behind why you would actually make a trade. So in the following examples, fundamental analysis will be used in order to decide whether to buy or sell a specific currency pair. So in the last lesson, we talked about how to make money and kind of went over the fundamentals of the different aspects of what you're going to see in a broker and what you're going to have to click and the different numbers and letters you'll have to understand before actually placing a trade. So each currency belongs to a country or region. So Forex fundamental analysis focuses on the overall state of the country's economy, such as productivity, employment, manufacturing, international trade, and interest rates. Now, that's not necessarily what you guys are going to be using all the time to actually trade. Me specifically, I am almost 100% a technical trader. I do take some fundamentals into account, but for the most part, I do focus strictly on technicals. But you need to understand that fundamentals are a big part of why and how the price of currencies move and how that affects the market. So starting off, we have Euro USD. The euro is the base currency and thus the basis for the buy and sell. So just like in the last lesson, I wanted to provide these examples, again, provided by babypips.com. We'll leave the links to the pages for this video down in the description below, as we do for every video. But we went over in the last lesson that there is the base currency, which is the first one in the pair, and there's the quote currency, which is the second one in the pair. And again, you are basically choosing to buy or sell the first currency, and then the price is quoted in the second currency of the pair. Okay, so you guys need to understand those fundamentals that we went over in the last lesson before you move on. So make sure you really understand that before you continue on with this series and with your education. So if you believe that the US economy will weaken, which is bad for the US dollar, you would execute a buy Euro USD order. Okay, so obviously if you think the US economy is going to weaken and the European economy is either going to stay the same or get stronger, that is going to make the price of this pair go down the price of this pair go up because the price is based on the euro, and if the price in US dollars goes up because the US economy is weakening, then that would execute a buy order. So by doing so, you have bought euros in the expectation that they will rise versus the US dollar. If you believe that the US economy is strong and the euro will weaken against the US dollar, you would execute a sell Euro USD order. And by doing so, you have sold euros in the expectation that they will fall versus the US dollar. Okay, so just a very quick example, breaking it down step by step, why you would buy and how you would buy, and then why you would sell and how you would sell. Okay, so we're going to go over a few more examples and then end this lesson off with a couple other terms that we want to understand before continuing on with the rest of the lessons. So USDJPY is for this example. So the USD, again, is the base currency and thus the basis for the buy and sell. If you think that the Japanese government is going to weaken the yen in order to help its export industry, you would execute a buy USDJPY order. By doing so, you have bought US dollars in the expectation that they will rise versus the Japanese yen. If you believe that the Japanese investors are pulling money out of US financial markets and converting all of their US dollars back to yen, and this will hurt the US dollar, you would execute a sell USDJPY order. By doing so, you have sold US dollars in the expectation that they will depreciate against the Japanese yen. This example includes the pound and the dollar. So the pound is the base currency and thus the basis for the buy and sell, and it is quoted in US dollars. So if you think the British economy will continue to do better than the US in terms of economic growth, you would execute a buy GBPUSD order. By doing so, you have bought pounds in the expectation that they will rise versus the US dollar. If you believe the British economy is slowing while the American economy remains strong, you would execute a sell GBPUSD order. By doing so, you have sold pounds in the expectation that they will depreciate against the US dollar. USDCHF. Okay, so the USD is the base currency and thus the basis for the buy and sell, and the Swiss franc is going to be the quote currency. So we're basically looking at, okay, how many US dollars can we get and what is the price in the Swiss francs? Okay, so if you think the Swiss franc is overvalued, you would execute a buy USDCHF order. By doing so, you have bought US dollars in the expectation that they will appreciate versus the Swiss franc. If you believe that the US housing market weakness will hurt future economic growth, which will weaken the dollar, you would execute a sell USDCHF order. By doing so, you have sold US dollars in the expectation that they will depreciate against the Swiss franc. So now that we got all of those examples out of the way, I want to move on into something called margin trading. So if you guys remember back a couple lessons, we discussed an example of, okay, we buy euros, 2 weeks later, the price goes up in USD and we sell for a $700 profit. Well, you guys may have been thinking, I don't have $10,000 or $11,500 to buy euros. Well, you don't actually need the amount of money that it says on the screen to buy a full position, because there is something called margin trading when it comes to Forex. So an example of this would be when you go to the grocery store and want to buy an egg, you can't just buy a single egg. They come in dozens or lots, in Forex terms, of 12. In Forex, it would be just as foolish to buy or sell €1. So they would usually come in lots of 1,000 units of currency, which is a micro lot, 10,000 units of currency, which is a mini lot, or 100,000 units of currency, which is a standard lot, depending on your broker and the type of account you have. Now, there's some brokerage that go below 1,000 units, but we're not going to discuss those too much right now. I'm sure we will later on. But continuing on, if you don't have enough money to buy 10,000 euros, as I said before, you can still trade in the Forex markets with margin trading. So you're still able to buy 10,000 euros as long as you are taking advantage of margin trading. So margin trading is simply the term used for trading with borrowed capital. So this is how you're able to open $1,250 positions with as little as $25, or if you have more money, you can open a $50,000 position with as little as $1,000, and that's going to be with a 1 to 50 ratio. So you're basically getting 50 times the amount of money you actually put up as the capital you're using. You can open a position 50 times larger than the capital that you're using, okay? And that margin can actually go up. So the margin I trade with is actually 1 to 100. So if I put $100 in, I can actually trade $10,000. 10,000, I can buy 10,000 euros with only $100. Okay, so there's different margin levels. Some people go way beyond 1 to 100. I really don't recommend going anything above 1 to 150, 1 to 200. I like to stick in that 1 to 100 range, and even sometimes I'll pull it back to 1 to 50. But again, we'll discuss more so on adjusting your margin levels and where you want to start off and everything like that later on when we get into some of the more advanced modules before you actually start trading in a paper account. So you can conduct relatively large transactions very quickly and cheaply with a small amount of initial capital. So an example of this, you believe that signals in the market are indicating that the British pound will go up against the US dollar. So you open one standard lot, which is 100,000 units of British pound to USD, buying the British pound at 2% margin and wait for the exchange rate to climb. When you buy one lot, which is 100,000 units of GBPUSD at a price of $1.50, you are buying 100,000 pounds, which is worth US dollars $150,000. So just to explain that a little bit more, 100,000 units of GBP quoted in US dollars, that's how you get $150,000. If the margin requirement was 2%, then $3,000 would be set aside in your account to open up the trade. Okay, so this is again that 1 to 50 ratio, right? Because it's $150,000 to open the position, you only need $3,000, and $3,000 times 50 is $150,000. So you can see here that we're using 1 to 50 margin. And that's a pretty standard margin level for a lot of the large brokerages. And again, you can up that if you go to some other brokerages that are also very legitimate and great to use, but just allow you to get a little bit more margin. But again, that's once you get into a little bit more advanced trading and a little bit more experience as well, and know how to control your risk and control your emotions. And again, this is stuff that I'm talking about that we're going to get into a lot later on. You guys just need to understand how margin actually works, because a lot of people think, oh, I don't have $10,000 or I don't have $1,000 even. Well, you don't need the money to open a position. You only need a very small amount of money to open a position, as long as you're taking advantage of margin, which you're going to be taking advantage of no matter where you go, no matter what brokerage you're using. They all use margin. So you can now control 100,000 pounds with just $3,000, right? So your predictions come true and you decide to sell. You close the position at, let's say, $1.50 and 500 and some change, whatever that may be, and you earn about $500. So as you guys can see, we're looking at only putting up $3,000, and that's a 16, almost 17% gain on one trade, and that's with a low margin level, right? If we went up to, let's say, 1 to 100, right, we would only need $1,500 to open up this position, and that would actually be a much larger gain, almost 30% gain, a little bit more than that actually, on just one trade. So you can see with margin, instead of just buying, like it said before, if you were just to buy €1 because all you have is €1, enough to buy €1, well, you're not going to make any money. You're going to make some cents on that, maybe 16 cents, and that's a waste of time. What you need to be able to understand is that we're using margin so that we can actually make a large percentage on each trade that we make based on the amount of money we're actually able to put up in our account. And we'll get into more stuff on risk management and how much capital you need and all that different stuff later on. You guys just need to understand that everybody's going to be using margin, and you need to be comfortable with using other people's money, which is going to get into things like risk management much later on throughout the training. So these were your actions. You bought 100,000 pounds at the exchange rate of $1.50. You can see there, and that was 150,000 US dollars. You only put up $3,000 though, because it was 1 to 50 ratio for the margin. You blink for 2 seconds and the pound USD exchange rate rises to $1.50 and 50, some change, whatever that may be, and you sell. And you then sell that for a $500 profit. So again, guys, this may happen in, like it said, a couple seconds or a few minutes or an hour, and you're able to make $500 only putting up $3,000. So even if you only put up, let's say, $100, you're still able to make a large amount of profit in a very short period of time with margin, and obviously a bunch of other things that come into play: planning out the trade, risk management, capital management. Those things are more advanced. We're going to get into that later, but you guys can start to see the magic behind trading Forex and how it can be so profitable in such a small period of time once you actually understand how to take advantage of this market. So when you decide to close a position, the deposit that you originally made is returned to you, and a calculations of your profits or losses is done. This profit or loss is then credited to your account. So what's even better is that with the development of retail Forex trading, there are some brokers who allow traders to have custom lots. This means that you don't need to trade in micro, mini, or standard lots. So that would be buying 1,000 units of a currency, 10,000 units, or 100,000 units of a currency. If you want to buy 1,542 euros because it's your favorite number and that's how many units you want to trade, then you absolutely can. So just the last term that we want to discuss is going to be rollover. So for positions open at your broker's cutoff time, usually 5 p.m. EST, Eastern Standard Time, there is a daily rollover interest rate that a trader either pays or earns depending on your established margin and position in the market. If you do not want to earn or pay interest on your positions, simply make sure they are all closed before 5 p.m. Eastern Standard Time, the established end of the market day. Since every currency trade involves borrowing one currency to buy another, interest rollover charges are part of Forex trading. So interest will be paid on the currency that is borrowed, and interest is earned on the one that is bought. So I actually don't worry about this too much because for the most part, I'm mainly a day trader. Sometimes I do take swing positions that I'll hold for a few days. But again, once I hold those for a few days, I don't really worry too much about rollover. I would recommend worrying about rollover if you were to trade, let's say on the weekly or the monthly or the daily time frames. But again, that's something we'll worry about a little bit later on once we're forming our trading plan and understanding how to build that into our strategy. So if you're buying a currency with a higher interest rate than the one you are borrowing, then the net interest rate differential will be positive and you will earn interest as a result. If the interest rate differential is negative, then you'll have to pay. So it's not going to be a lot of money that you earn or pay. These are the interest rates, and basically it's calculated based on the pair. So each pair will be different based on what currencies are paired up in what you're trading, and that will be able to calculate the rollover rate. But again, it's not going to be a lot. Not really something that I worry about too much or would recommend worrying about too much unless you're trading on a very long-term time frame where you're going to be holding positions for weeks, months on end, even years on end. That's when you should worry about rollover. So that is the final slide in this lesson. I know this lesson got a little bit long, around 17, 18 minutes almost, but I wanted to make sure we got through the whole entire lesson so you guys understand some of those examples. Really internalize the base and the quote lesson that we went over in the last lesson, and then also go over some things about margin, which is a huge thing to understand because a lot of people come into the market and don't believe they can make any money because the percentages and pips and everything like that doesn't really make sense to them until they understand what it actually means. So review this lesson. Again, I'll leave the links down in the description to babypips.com and the different pages we used to base this lesson off of. So you guys can go over there and review that before you move on to the next lesson. But besides that, that will conclude this lesson, and I will see you guys in the next one.